Thank you for joining us for our second HB Accountants podcast. We're thrilled to have you here with us today. We're going to be talking tax planning tips for businesses. I'm Vicky Foster and I'm joined by Amy Thompson, HB's tax manager, and Amy's assistant manager, Sabrina McCarthy. So the tax year ending soon, what better time to get your finances in order? Firstly, I do need to mention that HB accountants are governed by the ICAEW. Our podcast is for general information purposes and is not intended to constitute investment, tax or legal advice. We recommend you seek independent advice before making any investment, tax or financial decisions, and please remember, tax treatment is dependent on the individual circumstances. So without further ado, Amy, thank you for your time today.
Hello.
This is a great opportunity for you to introduce Sabrina to our listeners. Sabrina, welcome to HB Accountants. You joined us back in October last year. How have your first 5 months with Team HB been for you?
They've been great. I felt really welcomed into the team and I just really enjoy working here now.
And we're dragging you in for a podcast. So let's crack on. Why is year-end tax planning so important for businesses?
So it's really important to ensure as a business that you are spending expenses in a tax efficient manner. It's also really important for you to start considering the next tax year to ensure that you are in control and able to plan for future growth of your company. So throughout this we're referring to both companies and sole traders, so that's obviously whether you're a director and shareholder of a limited company or if you're a sole trader, so if you're self-employed. So we'll be going between the two of these, and most of the points we're going to make are relevant to both.
To both?
Yeah.
And what changes are coming in the new tax year?
The big one is the change in the national insurance rate. It's the lower threshold has gone from 9,100 to 5,000. And the rate has increased from 13.8% to 15%. So that's quite a big change for a lot of businesses. To combat this slightly, the employment allowance has gone from £5,000 to £10,500, and the threshold for £100,000 national insurance liability for employers has been removed. The allowance is still not available to single director payroll schemes.
So this is going to allow a lot more businesses that didn't have that national insurance employment allowance to receive it. So that will hopefully combat a little bit of the pain that's going to be felt from the national insurance increase going up. So this was the big thing that was discussed in the budget that Rachel Reeves has changed and the Labour government has changed. So that is coming into effect from the 6th of April 2025. So businesses really need to plan because their expenses are going to increase in relation to that.
Did you want to talk about the double cab pickups?
The other change for anyone that has a double cab pickup or uses them, that for most purposes they are now going to be classed as a car rather than a van. It'll be based on the primary suitability, and HMRC deem that if you've got 2 rows of seats, that's more likely to be a car than a van. So for both capital allowance purposes and benefit in kind purposes, they're going to be cars from April 2025. If you already own the van before April 2025, there are some transitional rules to allow for it to still be classed as a van for a while. This change doesn't affect VAT purposes, so it will still be classed as a van for VAT purposes if it was before.
So that's really important to start considering whether you want to continue to purchase double cab pickups as company cars. It might be better for actual vans to be purchased now when you're considering the rules for taxable benefits and for capital allowances. Also, it might be better off for tax purposes to purchase an electric car rather than double cab pickup now. So I'll definitely speak to your accountant or tax advisor in that regard before you make any purchases of vehicles after April 2025.
Great. And so what are some actions business owners can take in the light of the rules changing?
So definitely with regards to the way you extract profits, so salaries, it's going to be more complex now. So sometimes when we were looking at it, sometimes salaries were more efficient to take out than dividends. With the changes coming into the employer's NIC increase and the threshold, when you factor in personal allowances, other income and your company's specific circumstances, it might not be the most tax efficient option. So definitely you need to start considering how you're removing money from your business following the 6th of April when the changes coming into place. Dividends, now the dividend allowance is £500, and from 24-25, dividends still don't pay national insurance, you don't pay national insurance on dividends, I should say. So that's an extra tax charge that is taken off. However, dividends are paid from your post-tax profits, so you don't get an allowance for corporation tax purposes. So you really do need to consider salaries versus dividends.
Right.
It is based on company and individual circumstance, so we can't say for sure what's best for each person. It's an individual calculation, and speak to your accountant or tax advisor about that. So with regards to bonuses as well, something to consider prior to 31st of March, especially around directors' bonuses. So bonuses, they're subject to income tax, employee national insurance and employer national insurance, but reduce profits for corporation tax purposes. So the timing of the payment can affect both your personal and corporation tax positions. When we're looking at the changes to the national insurance rates for directors' salaries, you can accrue them in the accounts prior to the tax year end and still get relief. You could then run them through the payroll potentially prior to the 6th of April, which would mean you pay the lower national insurance rate. So it's really good to consider whether you can pay directors' bonuses prior to this change coming into place.
So speak to your accountant, essentially.
Definitely speak to your accountant, because we can't say for sure what would be best in each scenario. It's based on individual circumstances and company circumstances. Also, pension contributions. A lot of clients miss this. We always advise directors and shareholders that pension contributions paid directly from the company or even personally are so tax efficient. So really do consider as to whether your company could pay into your pension prior to the 5th of April, prior to the 6th of April, to ensure that you're using up your annual allowance. You can also carry forward annual allowances for 3 years, so that's something to consider with your tax advisor and your financial advisor. So really important point, definitely around pensions. They're very, very tax efficient.
How can businesses make the most of capital allowances before the year ends?
Just if you're planning on making any large expenditure, consider what year you want it to fall into. For most of the time, you'd want the relief sooner, so you would probably want to make it any large expenditure before your year end. However, there is the annual investment allowance that is limited to £1 million. So if you're considering making some very large expenditure, it might be worth spreading it over a couple of accounting years so that you can claim the full AIA rather than having to only claim normal writing down allowances or potentially first year allowances that are less beneficial in the long run.
Brilliant. And what should business owners do about dividend salaries, pension contributions? Is there still time for them to work on this now to save some tax?
So as long as you make pension contributions and dividend payments prior to the 5th of April, well, prior to the 6th of April, so on the 5th of April before that point, 2025, you will be taxed based on 24-25 tax rates rather than 25-26 tax rates. So definitely have a sit down with your accountant, tax advisor, financial advisor, consider strategies for extracting profits from your business or how your self-employment income is currently looking with regards to salaries and other income and things like that.
And for some people, you may actually wish to delay that dividend if you're near the £100,000 mark. You may wish to try and keep yourself below the personal allowance threshold.
Because once you get over £100,000, your tax-free allowance starts to get, your personal allowance, which is a tax-free amount of £12,570, starts to get abated, and that often ends up in being a 60% tax rate once it starts to get abated. So it's really important to, if you can, stay under the £100,000 income mark total for the tax year.
So essentially working with your tax advisor will potentially save you money and make your business more efficient.
And get you money into your pension, which is going to grow for your retirement.
Brilliant. Well, I think the key takeaway that I'm certainly hearing from both of you is around proactive tax planning, and essentially that will save your business money and save you stress, I would imagine, as well. A huge thank you to Amy Thompson and Sabrina McCarthy from HB Accountants today for all your time and sharing your valuable insights. As always, if anyone listening would like to receive an email summary of what we've covered, just drop us a message and we'll be happy to send details your way. And of course, our podcast will be up on our website and our YouTube channel. Lastly, thank you for joining us, and we look forward to supporting you on your financial journey. Please remember that information shared in this podcast is for general information purposes and does not constitute professional advice. While we aim to provide accurate and up-to-date insights, HB accountants and any of our guest experts are not responsible for any actions taken based on this discussion. We'd always recommend seeking professional advice suited to your specific financial or business circumstances. Thanks for listening. We're thrilled to have you join us as part of HB's community. Your support and engagement means a lot to us, and we look forward to bringing you more insights and discussions in the future.